On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.
Hello, welcome to the webinar. Today I'm joined by our amazing co-host Lindsay. We're going to be going through risk and reward, why everything you learned about risk is wrong. Bit of a bold title there. We kind of went for a bit of a bold title of everything you've learned about risk is wrong.
It was all John.
Is it? Yeah. Well, you pointed that way, and I'm like, on my screen, I'm on the other side of you.
Right, of course, yeah. Makes sense for me. I don't know how it's going to work for everyone else.
But first of all, how are you, mate? How you been?
Yeah, been good. I actually look a little bit jumpy on this, and I mean, my image looks a bit jumpy. Did we have this issue last week as well? I can't remember what we did to fix it, but we did.
I can't remember what we did. It's been a while since we've jumped on one of these.
It might be the screen sharing. I think it
was the screen share. I think if you get rid of the screen share, it might be a little bit better.
There we go. Let's try that.
But yeah, we got some. All good?
Yeah, I think so.
Yeah, cool. So we're going to be talking about risk today. You've obviously covered this before in your previous misconceptions webinar, and that went down really well. And I feel like risk is a subject that gets almost, I want to say, glazed over in the retail kind of trade and space. It's almost like everyone knows about risk in a certain element, or like they go, oh yeah, I just risk 1 to 2% of my account per trade. But then that's about it. There's nothing else really covered when it comes to risk. And I actually sent you a couple of stats before, and I know you touched on it before we jumped on. One that I really kind of resonate with is that 90% of traders lose 90% of their capital within sort of 90 days. That is the saying. I think it's a lot quicker than that from the stats that I see.
Wouldn't surprise me.
Yeah, and I really think that that's where risk is the misconception of risk really comes into it then, because it's almost like, well, if these people are coming in, they're only trading 1% of their account, that means that their performance is really poor, right? But one of the most common sort of things that I see is that people come in and have no stop loss in the first place. So I wanted today just kind of like cover off how to even sort of think about risk, not just here's my 1% risk, or I'm not going to bother with risk at all, but just kind of like risk in terms of like you put your account performance, how you can change risk per trade for volatility, how you can do X, Y, and Z. So I'm really interested to have this conversation today because you obviously have a higher level of experience when it comes to risk, because you've worked in various different institutions versus me, where I've been very much on the sort of retail scale of it. So first of all, I just wanted to get your thoughts on the stats that I gave you before, and why do you think traders just glaze over risk?
It's you know what, because it's not exciting. I think it sounds like a silly answer, but it actually is that. It's like anytime you start a new sport, let's use basketball, right? Because we're official partner of the Phoenix Suns, as everyone just saw. Everyone wants to start practicing shooting. They want to practice dribbling because shooting is how you score. Dribbling just looks good if you do it well, but no one wants to practice playing defense. No one wants to practice their footwork. And you kind of can't really have the other two more exciting things if you don't have the footwork down. And the example I always use is actually tennis, because in tennis, people only see the racket being swung and they think that's tennis. But anyone who's played tennis will know what a massive difference it is if you have your feet set correctly versus when you don't have your feet set. Like you're never going to have an air swing if your feet are set. Let's not say never, nothing's 100%, but it's very, very hard to air swing if your feet are set correctly. And I think it's a similar thing with trading and risk. It's just that everyone wants to get into the strategies of how am I going to make money. Don't worry about this boring thing over on the side, which is how careful do I have to be? How much should I risk on each trade? Now, I think there's a two-pronged thing, and you asked about the stats before. So you mentioned that first stat, which is a bit of a stunning one. And I think there's kind of two directions that the discussion on risk can go on. Maybe we'll touch on both of them today. So the first one that relates to the stat you gave is just in a vacuum, how much should you be risking per trade, and how do you stop yourself from blowing up your account, which is obviously super important because strategy and all that stuff means nothing if you don't have an account to trade. And the other second prong is, okay, assuming you don't blow up your account, then how does risk play in with rewards? So that was more the focus of anyone who watched the Trading Misconceptions webinar that I did, knows that I was focusing on that second one, which is the interplay of risk with reward. And that's a good way to segue into the other stat, which you gave me a few weeks ago, which is, let me get this number right, 65% of traders have a win rate above 50%. So that means 2 out of every 3 are actually getting more trades correct than they're getting incorrect. But they still lost money. And the only explanation that I can think of for that, I was trying to think, is there another thing, like brokerage or whatever that can explain it? But actually there isn't. The only way that can happen is if your risk and reward is out of whack.
That's exactly right.
So that's,
because
I guess, second prong.
I didn't reveal to you before the second part of that stat because I wanted to see what your reaction was. So the second part of that stat is the average winning trade is 1.2%, but the average losing trade is 2.8%.
Wow. Yeah. Not a surprise at all. And yes, that's the answer right there, which is why people are getting it wrong and how you can get a stat like that in the first place. Like in my misconceptions webinar, the example I gave was when one of my junior traders, he happened to do 2 trades in one session, just in the account that he was marking around with, and they happened to both be the same size with the same currency pair. So it made it very easy to compare. And his first trade made money and his second trade lost money. So without thinking too hard about it, he's got a 50% win rate. You drill down and actually look at what he did. His first trade made 8 pips, which is tiny. And his second trade lost about 25 pips. So his losing trade was 3 times as big as his winning trade. And if you do that, and this is what I told him as well, if you're going to have that sort of risk reward ratio, you have to get 75% of your trades correct just to break even. And that's very hard to get to 75%. So you're making it very, very hard for yourself when that's the ratio that you're going for. And the way I opened the discussion topic when I did my webinar on risk reward is the misconception that people have is that you're trying to win the most number of trades, when actually what you're trying to do is win the most amount of money. And that distinction, they're obviously correlated, but that distinction is actually super, super important. And it's something that people lose track of because they like being able to say to their mates, oh, look, I got 4 out of 5 of my trades correct. But really what is important is how much money did you actually make? Like the number of trades you got right or wrong. You obviously need more than 0. It's very hard to make money if you get 0% of your trades correct. But once you get to 1, it is theoretically possible to be a profitable trader. So really what the summary that we've got is that size matters. The amount of the profit and the amount of your loss is absolutely as important as whether you actually won or lost.
No, 100%, 100%. I think that's you've hit the nail on the head with a couple of points there. First point that you said a little bit earlier was risk is boring, and it is boring because it's not as exciting as learning a new strategy, or it's not as exciting as trying to figure out where the market's going to go. You know, a lot of people come into the markets and the first thing they do is they open the charts and they're just glued to them. They're trying to figure out what each little price movement means and how it's going to impact, you know, a potential trade entry or things like that. And then all they say to themselves is, well, I'll just put my stop loss above the high. I'll just risk whatever I want to risk, and I'll just put my stop loss above the high and then hope for the best. I think the problem is now people are so obsessed with that they just completely ignore that they, like you said, they need an account to even stay in the game. And I mean, you've heard of prop firms, right?
Oh yeah.
Or prop
I
trading
think
firms.
not as much experience as you with that, but yes, we've had brief discussions about it before.
Yeah. So I mean, I feel like prop trading firms try to bring in a little bit of like control or a little bit of discipline, because they set out rules per sort of account that you have. So if you have like a certain account or whatever, and you can only risk like 2% of that account per day, or you can only risk a certain drawdown of X amount in total before you kind of get a slap on the wrist and you can't trade that account anymore or whatever. So I feel like there is a start of a transition from retail traders to think about risk a little bit more in a little bit more detail. But the problem is they still don't think about it enough. And I was speaking to an ex hedge fund guy the other day, and he said he has a saying where it's kind of like he looks at like macro rates, all this kind of stuff, whatever, and he listed out all these things that were like part of his strategy, and then he said, but this doesn't really matter. The first thing I've got to worry about is risk. From the very, very start, he was like, all of these things, I can tell you to go look at this macro event and think about the narrative. I could go tell you to look at rates and go and do this. I could tell you my whole trading strategy. But if you don't know how to manage risk, you are going to get absolutely cooked. And I was just like, you're absolutely right. You know, even when I'm speaking to people like that, I am trying to figure out a little bit of nugget about, oh, what do they do? How do they see the markets? What kind of information can I like use from them to kind of implement into my own strategy? And it's quite funny that it always comes back to, well, I can teach you this, but if you don't know how to manage risk in the first place, you're just going to get absolutely swept away. And I was sometimes what I get to do at the broker is I get to review some accounts of kind of like clients' accounts and stuff. And one thing that I saw time and time again is people come in and they don't apply a stop loss to their trades.
Yeah.
And I was trying to figure out like why that is. And the only thing I can think of is I've seen a lot of things about traders think that big banks or smart money or whatever can see their stop losses. So they don't apply them, thinking that their stop loss
okay.
be like targeted in some way.
Yeah, I know what you mean.
Obviously, you've been on the institutional side. Is that true?
Okay, so if it's no, I mean the short answer is like I don't know how sophisticated these monitoring systems are, but what I can say definitively is that as a former head of trading at different forex brokers with access to all these clients' accounts, the people who are worried about me being able to see their stop losses, their accounts are way too small for me to be spending any time looking at that. And if I really wanted, firstly, we don't have the ability. I don't know how big you think these forex brokerages are, but we don't have the ability to be moving markets to the extent that we're triggering stop losses, especially in a market like the foreign exchange market, which what are we up to now, like 6 trillion a day? I don't know where we're at now, but it's only getting bigger. Like the big boys, like the investment banks, maybe they have the ability to plow in enough to move markets. We absolutely don't. So even if I could see them, I can't trigger them. But secondly, absolutely not something that I need to be doing. Like a trading desk can make plenty of money without having to resort to to those sorts of things. And actually, I had forgotten that this was a concern of some people until you mentioned it just then, which is why I laughed about it, because it just triggered my memory of, oh yeah, I have heard that before. And it's so anyone who's thinking that, just rest assured that this is not happening, because it's not worth the time for us to spend doing it.
I think a lot of traders obviously get into the markets. They get into this trade. They've planned the perfect trade out or whatever, and then they get spiked out and then go, oh, they've just hunted my stops. I'm the liquidity for this big bank to get, and it's just a load of rubbish. I mean, it's quite funny actually. I was doing a video the other day, and I was trying to do this this teaching point about risk and about how a lot of traders, first of all, they put their stop loss very tight, very, very tight. They a lot of them don't bother like leaving sort of big stop losses, or at least equate for stop losses with the volatility of the market. So I was kind of doing a video about where the sort of 3 positions of the stop loss could be from sort of like a retail trading perspective versus someone that thinks about the current volatility of the market. And I was doing this video and I put my stop loss. So I was trading euro dollar. I was using a minute time frame, which I would never suggest ever to do, but for video purposes, I was using a minute time frame because the market was moving. And I put my stop loss below the swing low plus ATR as like just a little bit of a buffer away. And my reasoning behind that was because, if price does come below that low but just gives like a little bit of a fake out and then the market continues higher, I'm still in the trade. If price kind of breaks below that, closes below, then the trade that I'm in is probably not going to work out, so I can cut my loss a little bit earlier. But as I was kind of talking through that, I was like, oh, the trade's going well. Like the market started moving up, and I was talking about moving my stop loss up, and then an announcement came out saying that the Trump administration would not go to Pakistan to meet with Iran's leaders or something like that. Yeah. And it just went dump straight into my stop loss and then straight back up and then carried on. And I was like, right. So that is a good teaching point again, just to show you that even if you do have a perfect plan, a perfect stop loss you think is all right, you just never know. You just never know what could come out. So it's more important to think about how much you're going to risk on that trade versus almost like where your stop loss placement is. You want to kind of have a bit of a balance of both. But I just thought it was funny. I'll have to show you the video because it was funny. I was it wicked me out, and I just sat there like, okay, so do I still talk about this now?
I just want to see your face when it actually happens. That's what I'll be watching. Don't worry about the chart.
But I think like to kind of like circle back to a point of kind of what I'm saying, even in that moment, I thought to myself, well, at least I only risked a very small amount on that trade, versus like a lot of people probably would have gone, full risk on something, or because people are coming in with smaller trading accounts, they feel like they have to risk more per trade versus somebody that comes in with a bit more of like a bit more capital behind them, essentially. But I don't know where you kind of sit on this as well, but I'm always a big believer of, you should do the same rules on a smaller account as you would with a larger account, because it teaches you that sort of discipline of, because you never know what happens. You could show somebody a track performance of 3 or 4 years and you get picked up by somebody, or people want to, be involved with how you trade because of X, Y, and Z. So, I just think that you should do the sort of right things first, even if your account is very, very small.
No, that's absolutely correct. It's actually segues perfectly into something that I was going to mention anyway, which is, okay, so anyone who's seen any of my previous webinars knows I like using poker analogies, just because the first institutional trading firm I worked at was founded by professional poker players, and we used a lot of gambling and poker theory. So there's different stakes you can have in poker. Like you could play at a 1-2 table, so the small blind's $1 and the big blind's $2. You could play at a 2-3 or a 5-10. The thing is, whatever bankroll or stakes you are playing should not affect your strategy. So good play is good play and bad play is bad play. It doesn't matter what the stakes are. But it's exactly what you said. The amount of your bankroll should be the determining factor in which table you are sitting down at. So if you don't have the bankroll to be playing at a $5, $10 table, that's totally fine. You can sit at the $1, $2 table. You can sit at the 25, 50-cent table, and it's fine. You build up your bankroll, and then, theoretically, let's just keep it simple. You double your bankroll. Now you can be playing double the stakes, and you could be doing exactly the same thing. And a lot of professional players who give coaching classes, what they'll say is there's no shame in, obviously it's good to be moving up stakes, but there's absolutely no shame in moving back down stakes as well. If you have a series of bad runs, or if it's not just a bad run and you're actually just not playing very well and there's a few things that you need to fix, there's no shame in scaling down to a lower stake, fixing all of your leaks, getting your bankroll back up, and then moving back up to, you're doing this for yourself, and it's not like you're being judged by outside people. And like, as we said at the start of this webinar, if you knock yourself out of the game, all of this exciting stuff, the boring stuff and the exciting stuff, goes out the window because you're not even playing anymore. And to take it back from poker to trading now, it's exactly what you said a couple of minutes ago, which is just because you have a smaller, it makes no sense. It's actually opposite to have a smaller amount of money and to be risking more. Like the amount you risk should be relative to what's in your account. And if you somehow lose half of your account, actually each trade that you have now should be half as big. And if you want to start doubling the size of your trades, then your account should be roughly double what it was when you started.
How would somebody, do you have any good suggestions of how people could get to that point? Would it just be based off of, because one thing that I did when I first started was I saw trading as a vehicle to sort of grow like investments and stuff. So I saw it as the CFD market was just a tool that I could use in like higher volatility events and things like that. So what I would do is I would kind of compartmentalize. So, I used to work for my dad's construction company when I was like 18, 19. So I'd get my pay. And what I would do is I would look at, obviously, prioritize my bills that I had, at 18, 19 years old. There's not many of those. It's like a phone and maybe a small car, a bit of petrol, whatever, beer money. That's all that is. And then it's kind of like, okay, well, what have I got to play with? So let's say I had 200 quid left over just to have a little play with. I'd go, right, half of that I'm going to split. I'm going to split half, put half of it into an investment account, half of it into a CFD trading account. And then what I did was every month I just topped up doing that. And before I knew it, I had like a decent sized trading account because I was trading smartly, plus I was adding into that kind of account, compounding it every single month. And I think that is something that isn't thought about enough either, is a lot of people kind of put in money into an account with the gambling mindset of, I'm going to double it, I'm going to triple it, but if you know that every month you're going to be able to add a little bit more into it, it kind of like takes the pressure off in a way, in a weird way. I don't know how you feel about something like that. But yeah, my question was kind of like, how would somebody take a bit of that pressure off from having to risk loads at the beginning? Because people put that money in, they think they have to risk it all just to make something, And from my experience, I did what I did, but are there other ways to do that? I don't know.
Oh, I wish I had a good answer for that, but I can't really say anything beyond like just don't do it. I mean, if you are sizing a trade, like again, this is all relative to the volatility of the instrument you're trading. I assume most people are trading currency pairs here, so it's the least volatile asset, but also you using leverage. And if you use more leverage than you should be, then that can get you into trouble. But if think about where you put your stop loss on the trade that you've just made, and if that stop loss gets triggered, how much of your account is going to come out? If the answer is say 1 or 2%, then obviously you're totally fine, right? You'd have to get 100 or 50 trades wrong just to lose your entire account. If the answer is somewhere near 50%, where you get one trade wrong and half your account's gone, probably safe to say that you're trading a little bit too large size. Now, what's the correct number? It's actually, we could be discussing this for ages, and I think we'd still not come to a definitive answer. It's obviously somewhere in between that, but I guess you just need to think to yourself, how many can I afford to get wrong if I keep using this size? Another way you can take the pressure off yourself is you answer that question, but at the same time also do what I said before, which is you get a couple wrong, just start scaling them down. Now, actually, if you do that, if you scale down as you go, as you lose, and you scale up as you win, it's really going to take one cataclysmic event that somehow, it triggers your stop loss, but you get slipped by so much that your stop loss is here, but you get executed down here. It's going to be near impossible for you to blow up the account because you are scaling up and down accordingly, and you've left yourself enough buffer. So by definition, you actually can never blow up your account if you do it that way. I understand it is very hard, and obviously there is a minimum lot size. So if you only funded your account with $100 and you're going 0.01 lots, you can't really go smaller than that, right? You can't scale down. But for most people, that's not really an issue.
I wondered, as you were saying that, it kind of sparked a little bit of a memory into my brain, just to be like, there was a game that I actually played online, and I wondered if this kind of plays into our, risk, because I don't know if you've seen this before. I'm going to bring it up on the screen because I actually think this might be a cool little thing that we can even do right now. Let me share screen here. And I don't know if you've ever seen something like this before. But this is a company called Elm Wealth, right? And the guy behind this is a big macro trader, predominantly more like stock indices and things like that. But he has created these like games that you can play in order to sort of understand certain elements of the markets. And one of them he's got is called the coin flip challenge, right? It says, welcome to Elm Wealth. Here's a coin flip challenge. Try your luck and assess your skill at bet sizing on the toss of a biased coin. In this game, you get to flip a coin that we program to have a 60% chance of coming up heads. You can bet any amount of money in your balance, but not more on heads or tails on each flip. If your balance goes to 0, it's game over. Make the game more exciting and instructive by imagining your balance as your total personal financial capital. Thank you and good luck for playing. So what happens is, let me see if I can start it. They might ask me to just put some details in here, but let's just put some details in. I won't show my personal email. Let me just put that off there a second. Let's just pop that in. But I just thought this might be an interesting way of thinking about risk as well. So here we have it. We have a $25 starting amount. You can place a bet of anything. We could go full risk, $25 if we really want to. But we have a 60% chance that it's going to be heads. So How would you play this game? I'm going to put you on the spot here.
Oh yeah, it's
I have actually played this game, and I made money on it, which obviously it's biased, so it is pushing towards the 60% heads. But it was interesting how it comes down to you've still got to make a prediction, right? And you can still get 3 or 4, 5, 6 wrong in a row. So it's how you manage your risk around that. I'm just interested to see how you would play
this is really good. And yeah, it actually is a perfect example of what we were speaking about. So I guess a couple of obvious statements. Obviously, anyone who's listening to us and is not betting on heads, I think has completely misunderstood the game, or maybe I've misunderstood it and I just wasn't reading it correctly. But obviously, that's the 60% is on heads. You should be betting on heads every time. Now, that's not the point of the game. The point is bet sizing and risk management. And obviously, betting $25 is not the answer either. But I guess it comes back to what I said before. Like if you're only risking, say, 1% of your bankroll each time, maybe that's a little bit small. But if you're risking 50%, then you can be pretty confident that that's too much. So I'm not going to say what the numbers should be, but I guess a framework for thinking about this is, yes, you have an edge here in a way that you're really not going to have most of the time in the market. I think I said this in one of our webinars, or maybe it was my webinar, but a lot of fund managers, they're happy if they can get 54, 55% of their calls correct. And in this case, you're told you're going to get it correct 60% of the time, which is great. So you want to be playing this game. So you want to think about, well, how many in a row could I get wrong feasibly? So let's just, we're at 40%, right? To get it wrong once. You get it wrong twice in a row, that's now 16%. You get it wrong 3 times in a row, now you're at about 6.5%, right? So let's just stop there for illustrative purposes. And you think, what are the chances I'm going to get it wrong 3 times in a row? 6%'s tiny, right? Like, what are the chances of that happening? I mean, there in the question, it's 6%. But that is small, right? Yeah. So then you might think to yourself, okay, it's fine. Like I'll risk 1/3 of my balance. What are the chances that I'm gonna lose it all? There's 2 things that people don't think about when they assess things in that way. The first is, like, 6% sounds small, but it happens more than you would like it to. So an example I'll give is, let's say that I propose to you some sort of activity. This has got nothing to do with finance. Some sort of activity or some sort of party or some sort of meeting. You get to meet your number 1 celebrity crush or whatever. I say it's probably going to be the best day of your life. However, there's a 6.5% chance that you're going to die at the end of it. Now, most people are going to be like, oh, hang on a sec. I think that 6.5% is a little bit. I understand it's going to be the best day of my life, but 6.5% is a little bit too high for me. And people can think of it in those terms when they're thinking in some other realm. But when it comes to money, numbers on a screen, something abstract, suddenly that 6.5% is viewed very differently by people. And we've spoken about this before, where when people can see and touch something, they think they understand it better. What maybe they do understand it better, but when it comes to numbers on a screen, suddenly the framework or the way that they frame things changes when actually it shouldn't. So firstly, 6.5% sounds small. It's way less than 50%, but it is meaningfully bigger than 0. Now, secondly, and more importantly, yes, 6.5% doesn't happen super often, but if you play this game again and again and again and again, which is what you're aiming to do, the chances of you losing 3 times in a row, now it's not 6.5% because you're not just playing once. It's almost a near certainty, right? And that's something that you need to think about. And this is the problem people run into with when they think the martingale strategy. And For those of you who aren't too familiar with that, that's just simply where you bet a dollar, and if you win, you just bet a dollar again. But every time you lose, you just double down. You bet 2, you bet 4, you bet 8, and you know eventually you're going to win. So it's okay. Now, of course, that is only okay if you have an unlimited bankroll, because you might think, look, it's going to take 8 consecutive losses for me to wipe myself out. It's very hard to do, and that's true. The first time you do it, the chances of losing 8 in a row is very, very small. But when you repeat the game and you play again and again and again, it is almost a guarantee that at some point you are going to hit 8 in a row. And that's something that people lose sight of as well. So I suspect the correct amount to bet here is much smaller than people suspect it should be.
Yeah.
Like, it's definitely not 12, it's not 10, it's not 5. It's somewhere much lower than that.
No, 100%. That was a really great way to kind of frame that, because again, as you were kind of like speaking, then I was thinking about the martingale strategy and thinking how many people would probably see that as a way to risk in the markets. It's very popular in sport betting. I know that, where, I mean, I don't know if you get this in Australia as well, but in England, there are a lot of people that offer like betting tips and things like that, and they call it like a 10-step challenge or something.
Okay.
So you put in like £100 or £50 or £10 or whatever, and what they try and do is they say, right, after we're gonna select certain odds per game, and what we're going to do is we're going to start off with almost like a riskier odd, you know, and we're going to just basically try and double our money every single time. So, and then that obviously because eventually the more times you play, you will get one or two times that it happens, probably over like 20 goes that you have, or like, you know, over 50 goes that you have. But it's almost like that one brings you back into profit again. And I wonder how many people view trading like that versus the other way around, because when you say it like that out loud, you kind of go, oh, well, surely that is a good strategy. But like you said, it really depends on how much money you've got to risk and if you have unlimited bankroll, because the size of what people probably want to try and do in trading versus like a sport bet, you know, I think a lot of people would be on the spectrum of, I'm going to risk really small on that, because you get the odds and you probably think, you know, these odds aren't great. Whereas in trading, I feel like people think the odds are more in their favor, if that makes sense. I feel like they think they know what's going to happen. It's like a weird difference.
Yeah, I guess. Yeah, I'm not too sure if that's. Yeah, maybe I'm still trying to think of the trying to understand the that example that you gave. But yeah, I guess I haven't really seen that before, so it's a little bit hard for me to comment on it. But if you're saying that people are overestimating their abilities in this, that's something I can absolutely get behind and agree with.
So. Yeah, 100%. But this is a fun little game anyway. I think if somebody wants to go and try this game,
it is
a fun little game as well. Just to have a little think about how you would risk in this term. They actually do another one which is quite fun as well, which I don't know if it would be relevant for now, but it's called the Crystal Ball Challenge. And again, I've played this one as well, which is quite interesting. So you get a starting capital of $1 million, and the goal of this is you get the headlines of tomorrow's paper before anybody else. So it's almost like you're an insider trader, right? And then you get two options. You get to either buy or sell the S&P stock market index, or you can buy and sell the 30-year Treasury bond futures. And you can do one or the other, or you can do both. But the game is you will get the headline before anybody else. So you have to then predict what's going to happen next. And again, I think this could be a good little game for somebody that is trying to understand risk as well, because what I found when playing this game was it's a lot more random than you think it would be. Like you think, oh, so one of the headlines, for instance, that you get is like, I mean, it changes all the time, but it's like NFP comes out, right? And it's like jobs numbers are at record highs, blah, blah, blah. So you see that. And I think a lot of people would go, oh, that's surely S&P 500 upside or whatever.
Yeah.
So you go to place your bet, and it gives you options then of how much you want to risk, how much you want to, place on that, how confident you are in that bet. And it's quite interesting to see how, a lot of the time it does the opposite of what you think. So then you're like, oh,
yeah.
I need to really actually think about how much I'm risking per event versus, trying to predict the outcome of that event. So again, it's another really good game to try and get your head around, because you may think, and I guess a good way to also think about this is like with my euro dollar trade yesterday that I was using as an example. I wanted to be short. I wanted to be long euro dollar for certain factors. There was the headlines were pretty. It was when we had the weekend news come out, and we saw the gap over the weekend, and the market was kind of just slowly trading back up, filling that gap or whatever. But it just was one of those where the markets reacted quite aggressively on the headline, but then the talks after the fact have been very like de-escalation, which has been recently over the time has been negative US dollars. So I was like, well, the trend of the day is up. I want to be on that side of that trend. So I took that euro dollar long trade. Obviously, then a short, snappy headline came out, took me out of that trade. But then my trade turned and did go in the general direction of my target. It would have hit both targets. And again, it kind of reminds me of this type of, you may be able to predict the markets well, but if you don't know how to risk, it doesn't really matter, because you can still get it wrong even if you're right, if that makes sense. It's not like getting it wrong or getting it right. It's almost like you can still lose money even if you go with the right direction of the market on the day. And I think that's something that traders don't think about either. You've got traders that go against the trend throughout the day and make money because they understand how much they're risking on the day, and they understand how much, what the reward to risk ratios are and things like that. But yeah, again, another little great game that I think if you have chance to sit down and have a little go and have a little play of it, I would definitely recommend doing it, because it is pretty fun. It is pretty fun. You soon realize how even when you are on the right side of headlines, sometimes the market can just do some really random things. So.
Yeah. It's no, that's actually a really good example as well. Like it touches upon a few things that we've discussed before. I think was it our previous webinar where I made the reference to how I just rewatched The Big Short, and how the guys that you're following that are absolutely correct, but the market keeps them wrong for longer than you'd like. Now, of course, because we're following them, we know eventually they all come good, but there would have been many others that we didn't hear about who correctly predicted the direction of the mortgage market, but just couldn't stay in the game long enough to realize those wins. Now, and I think we also touched upon in our last discussion on gold, where we said, okay, look, there's three fundamental factors that drive gold. Sometimes they're in conflict with each other, but sometimes they're all indicating in the same direction, and the market just does the opposite. And that's going to happen more than 0% of the time. And so you absolutely have to have that correct risk management and the correct bet sizing or the correct trade sizing to be able to absorb those. exactly for that reason. Like, how many times have we seen, like, say, a Bloomberg headline goes, is good news or is good news bad news? Because we can get a situation where job numbers are higher than expectations, but then that also reduces the chances of an interest rate cut that the market was hoping it was going to get. So actually now that good news becomes bad news. And I mean, that sort of outcome has actually happened on numerous occasions in the past 12 months. And yes, so it's exactly what you said. You get the headline and it gives you that edge, but maybe that edge is really only 60%. And 60% is fantastic. It's better than you're going to get the vast majority of the time, but it doesn't absolve you of the need to still assess your risk correctly.
No, 100%, 100%. So let's kind of let's think about, I guess, risk from a practical point of view, because we've talked a lot about risk today. The again, kind of gone through a lot about the misconceptions of or the misconceptions that I believe in, the misconception that you believe in. We've kind of talked about how the market can be random. So it's almost that is an important element to factor in when it comes to risk. What are the practical steps that somebody can take in order to sort of risk appropriately? Because I remember we had a conversation before and you were kind of asking me a little bit about risk, and I was telling you about, I look at my data a lot. I look at sort of where my best performing trades are, where my worst performing trades are, what type of market is that in, how volatile and stuff like that. So are there any kind of like practical elements that you think a beginner trader could start with that would just help them out, massively?
Yeah, sure. So what I'm going to do this time is I'm going to focus more on that second prong. So a lot of our prior discussion was on that first one, which is just how much should you be risking each trade? And really, I'll just reiterate the one main thing, which is if your bankroll has halved, the size of your trades should be roughly half as well. If you're still betting the same amount with half the money, then either you were not betting enough the first time or you're betting too much the second time. So let's go into, I guess, the realm of risk reward. So you mentioned that you had the chance to look at a lot of retail trading accounts, and that's something that I had the benefit of being able to do as well in my previous roles in forex brokerages. And it was not to hunt for people's stop losses, but for other reasons, I was able to look at these. And there's a few characteristics of bad trading accounts. So I'm going to list a bunch of these. And for anyone listening, if these match up with how your trading account looks like, then this would be maybe hopefully a little bit of a wake-up call that something needs to shift. So obviously, like, a bad trader is going to have a negative P&L. So that's a very obvious thing to see. But bad traders can also have positive P&Ls at some point, especially early on in the game. So one thing you can do, so I'm going to use an MT4 example because I think most people would be using that platform. If you just click on, it's going to be your P&L column and just sort by size. I think if you click on it once, it'll list your biggest wins at the top and your biggest losses at the bottom. And if you click it again, it'll flip and it'll go biggest losses at the top, biggest wins at the bottom. And just have a quick look. You can eyeball this, or you can actually put a spreadsheet in and say put your top 20 biggest wins, your top 20 biggest losses. Just look at the size of them. And what you'll see with bad trading accounts is the size of the biggest losses is way bigger than the size of the biggest wins. And what you want is the opposite to be the case. What you want to see is you want to have an account that has, because you're going to have losses. No one's going to go 100%. You're going to have a bunch of losses, but you want a bunch of small losses going with a bunch of big wins. And if your win rate is below 50%, that's actually fine if your account looks like the one I just described. But unfortunately, for most retail traders, it's actually the opposite. Like, they might have a win rate above 50%. It could be way above 50%, but all of their wins are small. and their losses are big, and you take it to an extreme, you're going to see one or two massive losses with a little comment that indicates that they've had their stop loss triggered, and that's basically wiped out their account. So that's one thing I would suggest. Have a look at your biggest wins and your biggest losses and make sure they're at least roughly equal, preferably with the biggest wins being bigger, not the other way around. Another thing would be, and this is actually something that I thought about when you made the mention of people not having stop losses in their trades. So it's not that we're hunting stop losses, but one way you can assess whether someone is likely to blow up their account is, I can understand if you don't want to put a stop loss in there, not because you want to hide it from the market, but just because, like, so I personally, if I'm actively watching the market, I don't mind if I don't put the stop loss in the actual trade, because I know in my mind, or at least on my chart, I've marked out where the stop loss is, and I've marked out roughly where the take profit is as well. But if somebody has a take profit in there without the stop loss, then that is probably an indication that they're thinking about this the wrong way, because really what you should have is you either have both in there, you have a stop loss and a take profit, or if you're like me and you're actively watching at the time, you have neither in there. So you know it in your head, but it's not there in the trade, and that's fine as well. But if you're only going to have one and not the other, you are more likely to be a better trader is if you have the stop loss in there without the take profit. So you protected yourself on the downside and you're actively watching for the best time to take your profits on that particular trade if it moves in your favor. If you've got it the other way around, where you put the take profit in because you want to lock in a profit, but you haven't protected yourself on the downside, then you know that you flipped this reasoning the wrong way around. So that was one very, very easy way to tell whether someone was a bad trader, is if they had the take profit in without the stop loss. Because there's really no excuse for that ever being the case.
Fair. So I brought up a little chart here. So this is the trade that I took on euro dollar, which is the one that knocked me out of the trade and then went towards the targets. I just wanted to get your feelings on this, of where you would place your stop loss. Just a fun little game. So this is where my stop loss was, this red line here.
Okay.
My entry was here, right? And let me just change that to a different color just so we can see it. I might just, so that's my entry, and then this was my stop loss. Can you see those lines clearly?
I can. Yep.
Yeah, cool. So because I obviously I'm just wanting to ask your opinion of where you would place your stop in this scenario, because I think a lot of traders, or in my opinion, would put their stop loss a lot tighter than I did. Now, this was just a 10 pip stop loss just because of the time frame that I was trading. But I imagine a lot of people who come to CFD brokers and trade, they're trading these kind of lower time frames. Or that's the evidence that I see anyway. So where would you place your stop in this scenario? I just want to have a feel of like where you would think about taking.
So we're going to make a lot of simplifying assumptions here. So I'm going to ignore the underlying volatility of this particular asset on this time frame and just look purely at the chart. Can you just hover your mouse over where you actually enter? Because there's a few points where it intersects with that. I don't want to give myself the benefit of like, well, I mean, I do have the benefit of foresight here, but so you got in there.
Yeah.
Okay, so your entry point. Okay, so you've got a setup that I know that we both like, which is you're going long and you're seeing the higher lows and the higher highs. So classic, right? So you can see that little, what's it called? It's a hammer, right? So
the
you've
power.
got that hammer right before you've made the entry point, and one obvious spot to put your stop loss would be just below that. Now I don't know how many pips below that,
Yeah, so
the bottom of that hammer, the actual, yeah. So how many pips is that from there to where you actually put it?
so that was only 6 pips.
Oh, and you moved it to 10.
I moved it to 10. Yeah.
Yeah. So I can totally understand why you would do that, and it's something that I might have done myself as well. There's a few reasons for this. 6 pips is actually very small. You are protecting yourself on the downside, but you are also significantly lowering your probability of this being a winning trade, just because it's very easy for that stop loss to get triggered. And I guess if you move that red line back down to the 10, to where you actually had it, I'm fine with this because there's a but coming, but I'm fine with this because I do this as well. Like, I will leave myself a bit of a buffer below the previous low, for very obvious reasons. But, and here's the but, it's not in a vacuum, and I think this goes back and segues very nicely into the actual title about this webinar, which is risk and reward. So if you've put the stop loss 10 pips lower, that is with a reward in mind that should be at least 10 pips higher. So another thing to answer the question that you asked before, for people just starting out, one way you can make things very easy for yourself is when you're thinking about how much you want to risk, so where your stop loss is going to be and where your take profit is going to be, the ratio should be at least 1-to-1, preferably clearly more than 1-to-1. So what I mean by that is the amount of profit you're going for should be at least as big as the amount of loss you're willing to endure. And if you look at that previous high, how many pips is it from the green line entry line to that previous high?
To this high here?
Yeah, to that one.
That was 9 pips.
Yeah, so that's why it's actually totally fine to have your stop loss at 10, because what you are targeting is you are targeting a new high. So it's going to be greater than 9. So
yeah,
what's
so
the first number greater than 9 is 10, so the ratio is perfect.
Yeah, the blue line was where I was targeting, which was around 15 pips. So I was looking to try and see if we would come back up into that. So on a higher time frame, there's like, you've got the 118 handle as a handle anyway. And we had tested that previously from before. One thing that what I looked at, so this is again, I think something that a lot of traders don't do, is they don't come and review the trade after. They look at the result and they go, that's they take the result as the fact, which it is, but at the end of the day, there are other nuances around what's happening. So when I look at this, I think to myself, did I put myself in the best position for this trade? And if I am answering honestly, I'd say yes, right? I put my position in. I've left myself enough room, because I talk about risk reward a lot in terms of trading. And sometimes what I like to do is I like to play around with how can I maximize my reward for the risk that I'm taking. So sometimes when it comes to an entry, I will look at sort of, okay, well, could I have had a better entry? For instance, could I have tried to get in a little bit lower than where I did? Now, obviously, the answer could have been yes. I could have tried to have waited for price to come here and just used like a buy limit order from this area. The problem with that is obviously you are having to buy when the market is going against you, rather than it giving you a little bit of a sign that it is starting to go with you. So I feel like your stats kind of, well, I know my stats, and my stats would be like, if I was to use limit orders, I would probably get a little bit chewed up versus when I don't. So that is a thing I always try and think about. Obviously, I could have, in hindsight, said to myself, well, actually, the sort of, where am I really wrong in this scenario? I think I could have probably extended my stop loss below that low in here, because
Yep.
in terms of like structure and the way I see structure and trend and things like that, that is the low that would be broken in order for me to really like go, oh, okay, actually, you know, I'm pretty wrong there. So I think for me, maybe I could have had a stop loss which was a little bit bigger. That would have extended it to 12 pips. Obviously, that brings down my reward in the terms of a monetary sense, but that would have kept me in the trade. So I think if there was something critical I could say about this, it's probably the fact that I haven't given it enough room below the low, which would actually mean for me that's a dead trade. So, I mean, the other thing is as well, I risked so little on this. I think it was like 0.01% of this demo account here. That, you know, because I use this one to like, do a lot of teaching on and stuff, I could have actually got in again because the exact same setup happened. And, you know, I could have easily got in on sort of that bullish candle there or this bullish candlestick here, for instance. I could have had a stop loss that was just below the low. And I think this also comes back in terms of like risk, because a lot of traders risk too much upfront first. So when they get taken out of a trade, they're just wiped out completely, or they don't want to go back in and risk again because they're scared to lose another trade. Whereas I'm a big believer in starting with a small size first. And then if the market is agreeing with me, or like, you know, obviously it depends on the time frame that I'm trading and things like that as well. But if I start to see signs that this is agreeing with me, so it's like, well, I can get back in, I can have a little go again, like, because I know that I'm risking so little that it doesn't necessarily matter for me to lose a couple before I get the one that I get on. And again, you have to think about your reward to risk ratio. You have to think about, you know, is there enough in it to actually achieve that in the first place? But I do think that's another thing that traders don't think about enough is that you may lose your first trade, but your second trade could be the one that actually is the one that really, you know, creates that move. Yeah, unfortunately, in this teaching scenario that I was doing, there was a headline that came out, and that's the risk that you run when you trade these time frames. You know, if I was trading like a 30-minute time frame or an hourly time frame, I'm probably not getting that same, you know, impact on my trade. You know, my stop loss is probably a hell of a lot wider versus, you know, what actually happened where I got, you know, taken out. You know, even a 15-minute chart, my stop loss on a 15-minute chart would probably have been down here, but then, you know, my reward to risk would have not been worth it. I would have just been like, well, this isn't even a trade to take. So sometimes you have to, like, you know, understand that when you are going down to these lower time frames, there are multiple different ways you have to view your risk in terms of, okay, well, I'm more likely to get stopped out because the size of my stop loss is very small versus what it would be on a larger scale. And two, not to over risk too much, so it gives me an opportunity to try and get back in again. So yeah.
No, I agree with everything you said, and I guess I'll highlight two of the things that I really agree with, which is number one, you mentioned people like to review their trade based on the result, when absolutely you should be doing it based on the process, not on the result. And again, poker analogy, you can play a poker hand perfectly and still lose it. It doesn't mean that you don't do exactly the same thing the next time. And if you've managed your risk and your bankroll correctly, you'll have the ability to keep taking that same good risk, and over the long run, you're going to make money. And secondly, you're absolutely right. Like people, and I would feel this as well. If you get gun shy, if the first time you have that foray in a particular direction on a particular currency pair with a particular strategy that just doesn't come off for whatever reason, you're reluctant to go in again. When you see the exact same setup again. But if you've reviewed it and you gave yourself the best chance to make money, there's absolutely no reason why you can't. And I said this on one of my previous webinars. This was years ago in a different context, but people are hesitant to go back into a previous stocks, always in the context of equities. They're hesitant to go back in, or the trade's moving against them and they don't want to exit with the aim of getting back in at a better price later. And the example I gave was it's a bit of a folly, because it's not like when they don't have a memory. You're not dating these stocks. So it's not like you dump someone now and then you go back to them a week later and they remember what you did to them before and it doesn't work out the second time. It's these stocks have no memory. They don't know that you sold them and you're getting back in at a better price. In fact, you're not even buying the exact same share. Like, you're buying the same stock, but it's a different parcel from a different person. So you don't need to be thinking about it in those terms, because this should be an unemotional thing. You're buying and selling it to make money. It could work out this time, it could not work out this time. You're very confident in the direction, but it's not working out this time. It's fine. You just get out of the trade, wait for a better opportunity, or if you get stopped out, wait for another good opportunity, get back in. There's no shame in this, in doing this, because it's not going to remember that you played with it before, right? So I think that's just, I mean, it's a humorous way of thinking of it, but hopefully that means that people are going to remember that there is no memory with these financial assets.
No, I love that. Right, I think we'll end it there. But before we do, what would be your top takeaway to go away today and think about risk? Like, what would be, let's say I'm going to put you in a scenario. You're a trader that has been trading for a year, maybe a year and a half. You're still consistently losing. What would you do? What would be the first thing you do when you look at when it comes to risk?
Oh, I mean, it's a loaded question, because you don't know why you've been losing. I would just say the most likely reason is simply to think about the ratio. Think about the ratio of what you're targeting, so your take profit and your stop loss, because you probably got that wrong. And just keep it easy for yourself. So whatever strategy you're using, and we could do a whole webinar on different strategies, but whatever strategy you're using, before you get into a trade, just have a think about what profit you're targeting and at what point are you going to admit that you're wrong on this trade. So again, where's your take profit, where's your stop loss? And just think about the ratio between those, and just make sure that the ratio is at least 1-to-1, preferably many times to 1. And if you can consistently get yourself into trades where it's, so again, I'll use the example that we both like, which is the higher highs, higher lows. And obviously, if you're going short, just reverse everything that I'm saying. But if you go higher highs and higher lows, if you pick the right time to enter, it'll be very obvious where the stop loss should go, somewhere a little bit below the previous low. And just have a look at what your potential upside is. And hopefully what you see is that it's many, many times above that. Just get yourself into situations where it's very easy to identify where the stop loss should be, and you're going to find things are a lot easier. And actually, you will feel better about it even when your trade does not work out, which is actually equally important, because you will know you made the right decision and you can just keep making that decision again and again. So I guess that's a very long-winded way of me saying, make the identification of the stop loss as easy for yourself as possible. If you can get that first bit correct, everything else will fall into place much, much more nicely for you.
Amazing. Thank you so much. Thank you for joining me again today. I always love these conversations.
Thanks for having me.
And hopefully, again, we'll do this again, because I do actually think there's a lot more to risk than meets the eye. So maybe we can even go a little bit more granular and pick something out. Maybe
Absolutely.
even apply it in some kind of like strategy sense. But yeah, again, really appreciate you joining me today, Lindsay. Appreciate it. And we will catch you on one very, very soon. So
yeah, a lot of fun. Thanks for having me.
Appreciate it. See you later.
On the court or in the markets, Performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.